Let me tell you something no one says at dinner parties. The dollar you're holding today is not the same dollar your parents held. It is not the same dollar that bought a house in 1970. Since the Federal Reserve was created in 1913, the US dollar has lost 97% of its purchasing power. 97%. The house your grandfather bought for $12,000 in 1955, that same house today costs $450,000. The dollar did not survive. You are holding the aftermath. And here's the part that most finance content skips entirely. The three assets I'm about to show you are not just inflation hedges, but one of them actually weaponizes inflation in your favor, meaning the more the dollar gets diluted, the richer you get from that specific position. That is not a theory, that is arithmetic. And we are going to do the arithmetic today. I am Marcus. I have spent over a decade running businesses, sitting across tables from accountants and tax attorneys who showed me how money actually moves, not how CNBC says it moves. The gap between those two things is where your net worth either grows or quietly disappears while you are busy feeling responsible. Today, I'm going to show you the three assets you need to own before the dollar continues its very long, very boring, very real collapse. And one of them is going to make you uncomfortable. Not because it is risky, because you already know you should own it and you have not done it yet. Here's the metaphor I want you to hold for this entire video. Imagine you own shares in a company, you bought them, you hold them, you feel good about it, but the CEO of this company, without a shareholder vote, without a press release, without a single phone call to you, has the legal authority to print new shares and distribute them to whoever he chooses. Every new share he prints dilutes yours. Your piece of the pie gets smaller, not because the pie got smaller, but because there are more pieces. Your slice did not move. The pie just grew more slices. This is not a metaphor for a fraudulent startup. This is literally, mechanically, how the dollar works. The Federal Reserve and the US Treasury can expand the money supply. And they do, and they have, and they will. Between 2008 and 2022, M2 money supply went from roughly $8 trillion to over $21 trillion. In 14 years, they created more new dollars than existed in the entire prior history of the American Republic. Your salary did not grow by 163%. Your savings account did not grow by 163%, but the number of shares outstanding did. That is the dilution, and the dilution is not a future event. I'm going to call this the share printer problem throughout this video. Every time I come back to it, I want you to remember when the CEO prints more shares, your existing shares lose value. It does not matter if the number on the screen stays the same. The real claim on goods and services that number represents has already shrunk. Let us start with the first asset, gold. I know what you are thinking. Gold is for doomsday preppers and cable news commercials, and honestly, I get it. The gold community has done tremendous damage to gold's reputation by tying it to apocalypse fantasies instead of institutional reality. But here's what they do not tell you. In 2022 and 2023, central banks around the world bought more gold than in any single year since 1967. That is from the World Gold Council. Over 1,000 tons per year, 2 years in a row. The People's Bank of China, the National Bank of Poland, the Reserve Bank of India, the Central Bank of Turkey. These are not preppers. These are the institutions that manage sovereign wealth for hundreds of millions of people. They have entire floors of PhD economists whose sole job is to figure out where to store value over multi-decade time horizons. And in back-to-back years, they chose gold at levels not seen in 6 decades, not tech stocks, not US treasuries, gold. You think gold is for paranoid people, but actually gold is for institutions that no longer trust the share printer to behave itself. That is the reversal. That is the thing that matters. Here is what most gold buyers get wrong. They buy gold like it is a stock. They watch the daily price. They stress when it dips. That is not what gold is for. Gold is not a return generating asset. It is a purchasing power preservation asset. When an ounce of gold went from $350 in 2001 to over $2,000 to $600 by late 2025, that was not gold becoming dramatically more useful. That was the dollar losing purchasing power against a fixed reference point. Gold is the ruler, the dollar is the thing being measured, and the ruler is not getting longer. You are not buying gold to get rich. You are buying gold to not get poor, while the CEO keeps printing shares. 5 to 15% of investable assets in gold is a reasonable allocation for most people, not 0, which is currently the number for most American investors under 55, not 50%, which will cost you the compounding returns that equities provide. ETFs like GLD or IAU are fine for most people. Physical gold for those who want zero counterparty risk. The point is not the vehicle, the point is the position. There's a man I want you to think about. Let us call him Robert. Robert is 47 years old. He works in logistics management. He makes solid money, and he has $400,000 sitting in a high yield savings account. Because, and I'm quoting him directly, the market feels risky right now. Robert has felt this way since 2023. Robert's savings account is currently earning about 4.5% annually, which sounds responsible. But here's the problem. The real cost of living for American households in Robert's income bracket, not the government CPI number, but the actual inflation tracked by private economists, has been running closer to 6 to 8% for the past several years. Robert thinks he is being conservative and careful. Robert is actually losing somewhere between 1.5% and 3.5% of his real purchasing power every single year while he waits for clarity. Over the past 3 years, Robert has quietly surrendered somewhere between $20,000 and $40,000 in real purchasing power, not in a crash, not in a scam, in a high-yield savings account, the safest place he could find. This is the share printer at work, and Robert is calling it discipline. We are going to come back to Robert. By the way, if you are finding this useful, hit that subscribe button. YouTube's algorithm buries channels that do not get subscriber signals. It costs you nothing, takes 2 seconds, and drop a comment. Let me know what asset you are holding that you know you should probably rethink. Now we move to the second asset, real estate, and I need you to stay with me here because this is the one that changes the math the most. Most people think about real estate as an appreciation play. Buy a house, value goes up, sell it, profit. That is fine. It also describes how most people lose money in real estate because they buy near the peak of a cycle. Appreciation is not the weapon. The debt is the weapon. Here's the thing almost nobody puts together. When you take out a 30-year fixed rate mortgage, you are locking in a liability denominated in today's dollars, but you are going to repay that liability with future dollars. And if the share printer is running, if inflation is real and persistent and above the rate at which your fixed interest compounds, those future dollars are worth less than today's dollars in real terms. You borrowed expensive dollars, you are paying back cheap ones. Inflation is retiring your debt for you incrementally every single month. This is not a loophole, this is arithmetic. Let me make this concrete with a real-world example. In 2012, a school teacher in Nashville named Teresa bought a duplex for $180,000. She put $36,000 down. She borrowed $144,000 at a fixed rate of 4.25%. At the time, people told her she was overpaying. The neighborhood was fine but not great. The numbers barely worked. She held it. 12 years later, that duplex is worth roughly $380,000. Her mortgage payment has not changed, but market rents in Nashville have nearly doubled. She is now cash flowing over $1,200 a month on a property where she originally struggled to break even. Here's the part that matters. The real value of her $144,000 debt has been cut by inflation by nearly 40%. She is paying back a loan with dollars that are worth significantly less than the dollars she borrowed. Meanwhile, the property has tracked nominal inflation. Her tenant has been paying down her debt for her, and she did nothing except hold. The share printer, which her neighbors were complaining about at dinner, was quietly building her retirement. Now I know someone is thinking, real estate prices are high, rates are high. This does not apply to me right now. I hear that. The entry point matters. Cash flow from day one is not negotiable. If the rental income does not cover the mortgage, property taxes, insurance, and a 10% vacancy reserve, you do not have an inflation hedge. You have an expensive hobby with a lot of paperwork. The debt weapon only works if someone else is paying the debt service. That is the rule. Cash flow positive from day one. Fixed rate, hold through inflation. That is the whole strategy. And if physical real estate is not accessible right now, publicly traded REITs get you most of the inflation hedge mechanics without the complexity. Prologis, Realty Income, Equity Residential. These are companies that own thousands of properties, carry long-term fixed rate debt intentionally, and are legally required to distribute 90% of their taxable income as dividends. Boring, durable, more durable than almost anything else in your portfolio during a sustained inflationary period. Let me check in on Robert real quick. Remember Robert with the $400,000 in savings? I told Robert about REITs. Robert said, and this is real, I would buy a rental property, but I do not want to deal with tenants. Fair enough. So I explained the REIT structure. Robert nodded. Then he said, But what if the company goes bankrupt? I said, Robert, the company owns warehouses in 47 states. The warehouses do not disappear if the company restructures. He thought about that for a while. Robert is not fast, but Robert is the person most financial content ignores, and Robert is also the person most likely to actually implement something if it is explained without condescension. Now, the third asset, Bitcoin, I want to warn you that this is the one people dismiss based on association rather than analysis. There is a version of this asset that is genuinely ridiculous and a version of it that is one of the most important financial innovations of the last 50 years. And they look identical from the outside. That distinction is what separates the people who made money on it from the people who lost money on it. Let me be clear about what I am not arguing. I am not arguing a price target. I'm not arguing a halving cycle. I'm not arguing that Bitcoin is going to $1 million. I do not know the price of Bitcoin in 3 years. Nobody does. Here's what I'm arguing. Bitcoin is the only asset in human history with a verifiable, mathematically enforced supply cap that is immune to political decision making. 21 million coins total. Not a promise, not a policy, not a mandate that can be reversed by a new administration, code enforced by a decentralized network of computers distributed across the entire planet. The share printer cannot reach it. That is the entire argument. Let me put that in context with every other asset we have discussed. The Federal Reserve can print more dollars, they have repeatedly. The supply of gold is constrained by geology, but as the gold price rises, mining becomes more profitable, more exploration happens, more gold comes out of the ground. Gold supply has increased by approximately 1.5% to 2% per year historically. Real estate is bounded by land availability in specific markets, but globally, land is not scarce. None of these things have a hard, auditable, unchangeable supply ceiling. Bitcoin has exactly 21 million coins. As of early 2026, approximately 19.8 million have been mined. The remaining ones will be issued on a predetermined schedule that halves every 4 years. The last coin will be mined around the year 2140. There are roughly 330 million Americans. If every American wanted one full Bitcoin, that would require more than 15 times the total supply that will ever exist. The scarcity is not a marketing claim. It is arithmetic. Here's the thing about volatility. In 2018, a software developer in Austin named Michelle bought $10,000 worth of Bitcoin. She watched it drop to $3,500. She did not sell. She did not panic. She had sized it correctly. That $10,000 is now worth significantly more. But the point is not her returns. The point is that she survived the volatility because she had allocated only what she could afford to hold through a 70% drawdown. Bitcoin dropped over 70% from its peak in late 2021 to its trough in late 2022. Anyone who had their retirement savings in Bitcoin during that period made an allocation mistake, not an asset mistake. The asset is only as good as your ability to hold it through that kind of decline without making an emotional exit. 5 to 10% of investable assets in Bitcoin held in cold storage or a regulated custodian is a position you can hold through a 70% drawdown without destroying your financial life. 100% in Bitcoin destroys people. The difference is not the asset, it is the allocation. It is always the allocation. Let me tell you about Robert one more time. When I explained Bitcoin to Robert, he said something genuinely wise. He said, I do not really believe in Bitcoin, but I put $5,000 into it anyway. I figured losing $5,000 on something I do not understand is better than losing $20,000 on something I thought I did understand. Robert, without knowing it, had described position sizing more accurately than most financial textbooks. You size speculative positions by your psychological ability to hold through loss, not by your conviction in the outcome. Robert is going to be fine. Now let me give you the case study that ties all three assets together. Two people, both 35 years old, both starting with $250,000 in investable assets, both disciplined. Person A does what their financial advisor recommends, 60% in a broad market index fund, 40% in investment grade bonds. This is the standard moderate risk recommendation that has been handed to American savers since the 1990s. It was designed for an environment where inflation averaged 2% and bonds actually generated real returns. Person B reads the boring documents. Person B does something different. They take $100,000 and use it as a down payment on a $400,000 rental property with a 30-year fixed rate mortgage. They put $60,000 into gold split between GLD and physical. They put the remaining $90,000 into a diversified equity position with a 10% Bitcoin allocation, which is $9,000. Not a bet, a position, run both scenarios forward 20 years, assume 3.5% average annual inflation. Person A's bond portfolio delivers real returns that are at best flat. Their equity portion grows at maybe 7% nominal, which at 3.5% real inflation translates to roughly 3.5% real annual return. So person A ends up with somewhere around $450,000 to $500,000 in real purchasing power. The person B's rental property debt has inflated away. The $300,000 mortgage is now worth roughly $150,000 in real purchasing power. The property itself has gone from $400,000 to approximately $800,000 nominal, roughly $400,000 in real terms. Net real equity on the property alone is $250,000 generated on an initial $100,000 investment, with the tenant having paid the mortgage. The gold allocation has preserved purchasing power, still worth $60,000 in real terms. The equity portfolio on $75,000 at 3.5% real return is approximately $150,000 in real terms. The $9,000 Bitcoin position, using a conservative scenario, could reasonably be between $30,000 and $90,000 in real terms. Person B's total real outcome is somewhere between $540,000 and $600,000 in real purchasing power, comfortably ahead of Person A, with dramatically lower correlation between assets. No single collapse in any one category destroys the whole thing. The point is not that Person B is a genius. The point is that Person A owned only assets denominated in the thing being diluted. Person B spread across assets that have different relationships with the share printer. And before you go, if this video hit home, hit that like button. It helps more people find this content. And drop a comment. Tell me one asset you are adding to your portfolio this month. Accountability matters. Let me bring Robert back one final time. The last time I talked to Robert, he had moved $30,000 of his $400,000 savings account into a REIT index fund. Not a lot, enough to matter. He bought 4 ounces of gold, a purchase he described as embarrassing but correct. And he put $5,000 into Bitcoin in a regulated custodial account. Not because he converted to anything, but because he finally understood that his discomfort with the asset was not a reason to have zero exposure to the only supply cap liquid asset in existence. Robert is not moving fast. Robert is not exciting. But Robert is now sitting in a position where 3 different asset classes are responding to inflation in 3 different ways. 1 preserving purchasing power, 1 using fixed rate debt as an inflation weapon, 1 holding a position that the share printer fundamentally cannot dilute. Robert's $400,000 is no longer entirely dependent on the goodwill of one CEO with a printing press. That is a better position than Robert was in a year ago. Not perfect, better. And in personal finance, better is almost always the enemy of waiting for perfect. 3 assets, 3 structural positions, not a portfolio, a posture that says, I understand what the dollar is. I understand what dilution means, and I am not going to let the share printer silently reduce everything I have built while I wait for a better time to act.